from the heart of where innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, social media executives in the hot seat on Capitol Hill. Current and former employees from YouTube, Meta, and TikTok taking questions about privacy, security, and misinformation. The question remains, how do regulators get ahead of a rapidly evolving social media landscape? We'll have more on that in a moment. Plus, the Ethereum merge is closing in. What does it mean for the blockchain and the crypto landscape at large? That later this hour. And the trial of Nikola founder Trevor Milton is heating up, with a former contractor turned whistleblower telling a jury he made $600,000 by contributing information to that short report that spurred Milton's downfall. We will have that story. First, though, I want to get a look at the markets. Tech stocks rebounding, outperforming the broader market. The push higher coming a day after the biggest sell-off in more than 2 years, as hotter than expected inflation data makes next week's Fed meeting that much more consequential. Bloomberg's Ed Ludlow here with the biggest moves. Ed, a sigh of relief today.
Yeah, a little bit. There was a bit of tug of war in the market on Wednesday. Everyone's trying to make sense of what that inflation print means for Fed policy going forward. But the tech-heavy NASDAQ 100, a real outperformer among major indices, up 0.8%. Semiconductors also doing well as well. The Philadelphia Semiconductor Index, or SOX, up more than 1%. If there was an area of weakness or sustained pressure, it was in Bitcoin, which holds below that $20,000 per token level, which it breached 24 hours ago. We are thinking about what happens next, right? Look at this terminal chart. The policy-sensitive 2-year continued to push its yield up throughout Wednesday's session. You see that big jump in the yield on the 2-year Tuesday, coinciding with that big drop of the NASDAQ 100. And this is where it's all playing out. This is where we're keeping our eye ahead of that key Fed meeting next week. In terms of the key movers, of course, there's a big news cycle going on in the background. We forget that there's a lot of movers on the move. Tesla, actually one of the best performers, despite basically negative headlines. The first, that there's a lawsuit that's hit Tesla claiming that it's deceived car owners about its car's self-driving capabilities. Also reports out of Germany that an expansion of their factory near Berlin has been put on hold. Interesting to see some pressure on some social media stocks as well. Of course, former executives speaking to senators about what they think needs to happen in the regulatory landscape. How often are we having this conversation, Em? Often, though, not pressuring the stocks. It's hard to draw a causal relationship here in the market, but some social media names a pocket of weakness this Wednesday.
And that has been a pattern, Ed. Thank you. We'll see you later in the show. Well, for the first time, as Ed mentions, top execs in charge of product design and operations for Meta, YouTube, Twitter, and TikTok all testifying on Capitol Hill. Before they were even questioned, though, a panel of former executives testified about prioritizing growth over moderation. They were all questioned during the Senate hearing with the Homeland Security Committee about online extremism and user protections. Many of the answers from the current employees were open-ended. Take a listen to this back and forth between Senator Rob Portman and TikTok COO Vanessa Pappas.
Can you make the commitment, though, that I just asked you to make, that you will commit to cutting off all data and metadata flows to China, Chinese-based TikTok employees, ByteDance employees, or any other party located in China?
What I can commit to is that our final agreement with the U.S. government will satisfy all national security concerns, yes.
But you won't make a commitment to agree to what I have now twice asked you about?
Sorry, given the confidentiality of CFIUS, I'm not able to talk specifically about that agreement.
I'm not talking about CFIUS. I'm asking whether you'd make the commitment today.
Here to discuss, Techonomy CEO and editor-in-chief David Kirkpatrick, as well as Bloomberg's Alex Barinka, who covers social media for us. So, Alex, let's start with the big takeaways, not the least of which was Vanessa Pappas's exchange there with Senator Rob Portman.
Yeah, and Vanessa's exchange with Portman wasn't the only testy exchange she had. Josh Hawley, another Republican on the Senate panel today, also questioned her, basically voicing what we've seen a continuation of concerns from Republicans as to whether or not the company will give any data to the Chinese government. She has unequivocally continued to say, no, we will not, but she would not go so far as Portman asked to say we will cut off all data. Now, Emily, kind of true to how these hearings seem to be going lately, the conversation has been really wide-ranging outside of just the TikTok context. We have executives from Facebook, from Twitter, and from YouTube there today, and the questions have ranged from responses to some of the allegations we heard this morning that the companies prioritize growth over everything, including user safety, to also getting really specific in the case of Twitter, asking Jay Sullivan over at Twitter whether or not he would commit to saying that the company did not misrepresent information to the FTC. So, Emily, the panel is ongoing as we speak right now, but I'm sure we'll continue to see a range of topics out of this conversation.
Well, David, to that point, maybe even more interesting than hearing the executives testify was hearing the former executives testify at the pre-hearing. What do you make of the concerns that they raised?
Well, it was very meaningful. And it was meaningful not just because they're critics, but because they are such deeply informed critics who are themselves former insiders. So both the former executives from Twitter and from Facebook were among the highest ranking engineering people in the company. In the case of Twitter, he was head of engineering there. And these are people who are now telling the senators that disinformation is not a priority for these companies, that growth, user growth and user engagement is always prioritized in systems management and design, and that is why the problems exist. And they also were very emphatic that there are tools that could be implemented by government that could require these companies to change that. But they need the incentives from government, and otherwise they're never going to change.
Well, let's talk about that. I mean, there have been hearings like this now for several years, and regulation has yet to catch up. Given the speed at which social media moves and the lack of speed at which regulation moves, how much do you think, David, that this is really going to push the envelope on regulation?
Well, unfortunately, even though the intelligence of questioning at Congress has steadily increased, and I think today's hearings showed that the senators are significantly more informed and probing in an intellectually legitimate way when they talk to these leaders of the tech companies. But in reality, the disagreements between the two parties in terms of what the real harms are, and the general, I think, ambivalence, even among ostensibly angry senators and congresspeople, about whether they really want to rein in these services is going to mean that in the U.S., we're not going to see meaningful regulatory change in the near future. Europe is going to continue to be dramatically in the lead. Now, that's a good thing, at least that somebody's doing it.
Alex, talk to us about the responses from the companies today. I mean, I'm sure by this point, these kind of hearings are par for the course for them. It also seems like their strategy is improving.
It is a little bit, and you do see them at least seeming like they're wanting to play ball to a certain extent. But I did want to highlight something that David just brought up in terms of the tension between the two partisan groups of these senators and how that's manifesting itself and how the companies are coping. One piece that the Republicans in Senate have been really fixated on is this idea of content moderation and what that means. We saw a lot of questioning today from Republican senators trying to get to the bottom of why certain content in regards to some ideas around COVID, in regards to ideas around the election, why that content was removed from the platform and what went into the content moderation choices, and some criticism and allegations from the senators that the companies are operating as kind of partisan. The executives today from YouTube, from Facebook, they were basically able to come in and say, look, we defer to a lot of our third-party fact checkers. Emily, these folks are pretty adept at also sidestepping questions, giving an answer that feels comprehensive. But they did lean in to kind of say, you know, we are trying to work with people who check themselves and who remain bipartisan. So that is an important kind of point in this ongoing political debate as to what happens next out of these hearings. The Republicans seem to be very fixated on some of these issues around content moderation and around China, whereas the Democrats are leaning into some other ideas like, pushing for further controls and questions around the algorithm. So again, these tensions manifesting itself seem to be continuing to raise the level of these conversations, raise the tenor of these conversations, and the quantity of executives going down to Washington. But it has kind of ground some progress to a slower pace than I think some legislators would want.
This, of course, coming a day after Twitter whistleblower and former employee Peter Zatko testified on Capitol Hill. Let's take a quick listen to more of what he had to say, speaking to this question of what is the role of government versus companies when it comes to regulation. Take a listen.
It took me maybe 30 minutes to reach out to an employee and say, what do we know about this person? And then it only took that person maybe 10 minutes to get back to me and said, okay, here's who they are. This is the address where they live. This is where they are physically at this moment. They're on their phone. We know their phone number. We also know all of the other accounts that they've tried to set up on the system and hide. And we know who they are on the other social media platforms as well.
It's kind of amazing, David, how much you could learn about an individual user, as any Twitter employee. What were your big takeaways from the hearing yesterday and the potential repercussions of this, not just for Twitter, but for all of social media?
Well, what he was just saying about the ability of these companies to know incredibly detailed information about individuals is highly important. But frankly, the thing that I think was most significant about the hearing with Zatko is this idea that he was so emphatic in insisting on, that Chinese government and other foreign entities have implanted essentially spies inside Twitter, and that he had evidence of that, and that the company wasn't even that concerned about rooting them out. This, for me, as a longtime observer of Facebook and social media generally, has been a very serious concern. So I expect that'll be a big issue going forward.
And wouldn't it be an even bigger issue potentially for TikTok?
Well,
yeah, I mean, I think it would be to see the line of questioning we saw today. One of the senators really went into TikTok COO Vanessa Pappas, asking if any of their employees are have known affiliation with the Chinese Communist Party. She pushed back, saying, "I don't know the political affiliation of any of my employees," but then also informed the panel that none of the strategic decision makers have associations with the CCMP. So a kind of a non-answer there from Vanessa. Right. But I bet that will continue to be on the mind of U.S. legislators.
Very, very consequential stuff. Alex Barinka, David Kropatschek, lots to continue to unpack here in the days to come. Thank you for joining us. Okay, coming up, how Twitter's chair of the board is handling Elon Musk's attempt to cancel the $44 billion deal. That's next. This is Bloomberg. Let's go behind the scenes now of the biggest tech deal of the year. Bret Taylor is the co-CEO of Salesforce, also inventor of the like button at Facebook, co-founder of the software company Quip, and the chairman of the board at Twitter. He, a major player in trying to push that $44 billion deal with Elon Musk to go through. Joining me now, Bloomberg's Brody Ford, who profiled Taylor's role in this Twitter deal. So, Brody, Bret Taylor's been a guest on this show many times. He's, a very out front executive. We haven't heard a lot from him since taking over the chairman of the board role at Twitter, and this Elon Musk drama started to unfold. What have you learned from your reporting on what he's doing behind the scenes?
Yeah, the thing that kept coming up to us is this idea that you would be hard-pressed to find two people more dissimilar in their public face than Elon Musk and Bret Taylor, right? I mean, we have a situation where Elon is just posting real trollish things, sending poop emojis at executives, and Brett is playing things very by the books, right? Chairmen of boards are always critical in M&A environments, but even more so here since Brett Taylor has so much experience in deal making in the past. And particularly since, there's been a lot of upheaval at Twitter, right? So he has been critical in this situation. He has been known to work well with strong personalities. And what we're seeing now is whether that has extended to his relationship with Elon.
What Peter Zatko, the former Twitter employee turned whistleblower, had to say about Twitter's board was not very flattering at the hearing yesterday, saying that when presented with security concerns, Twitter's board did nothing. Does that make Brett Taylor look unfavorable?
I don't think so, because, the way I think he has viewed this is through a phrase he has defined at Twitter's employees many times: fiduciary duty, right? He has said all along that, look, my job here is to get the best deal he can, and that's what he's been going for. But I think what's really interesting here is this is somebody that's managed to come out of every situation looking like he got a good deal, looking like he was the slick business player. But with Twitter, he might have found himself in a no-win situation, right? I mean, if he succeeds in court in October, he sold the company to somebody who doesn't want the company. Even if he settles, the company's really been through the ringer and will probably get sued by shareholders. So it's going to be a tough situation here for the board and for Brett Taylor.
All right, really interesting profile you did of Brett Taylor. You can read more of Brody's story at Bloomberg.com.
Thank you.
Okay, coming up, we're going to hear from a top executive at the so-called Amazon of Latin America, Mercado Libre, the outlook for consumer spending amidst inflation and a downturn from another side of the world. This is Bloomberg. Let's take the temperature now of an e-commerce company and the fintech landscape in Latin America with Pedro Arnt. He is the CFO of Mercado Libre, one of Latin America's largest companies with operations across 18 countries. Pedro, thank you so much for joining us. Mercado Libre, of course, is referred to as the Amazon of Latin America. And given that, I'm just curious for your outlook, given the economy, record inflation, how's that impacting your outlook and your customers?
Hi, Emily. Thanks for having me. So definitely a similar situation with high inflation across the region as in the US. I think two contrasting elements are, first of all, Latin America historically is a region with higher inflation. We've spanned countries where inflation is running at 60%, like Argentina. And so both the consumer, but also companies and managers are more accustomed to cost pass-through and managing their personal lives or their businesses through inflationary times. So it's a bit of a contrast to developed markets where you guys, in a way, had grown unaccustomed to inflation. And the second piece is that because we are at an earlier stage of e-commerce penetration and development throughout Latin America, many of the pandemic gains are not being given back now that consumers are moving back offline. And so we continue to see, as we look into H2, sustained growth rates similar to how we entered the year in terms of consumer online spend and how much our businesses are growing.
So, given all of that and coming out of a pandemic where, for a company like Amazon, business was booming and is now pulling back a bit, what is your outlook for growth?
So sustained growth similar to what we saw in the second quarter. We hit revenue growth north of 50% Q2, constant currency adjusted. And again, because the secular tailwinds are still very strong, internet commerce as a percentage of overall retail is still high single digits or low double digits across most of our markets. We're still in a phase of the J-curve of adoption where there's still significant wind behind our sails. And so we haven't really changed our outlook for H2 growth and a similar trajectory to what we were seeing during the second quarter. So optimistic about the business and continuing to ride the revolution of consumers moving online, both for commerce and their digital finance throughout Latin America.
We're always fascinated with the logistics of massive companies like yours, and I understand you're looking at expanding your electric vehicle fleet significantly. How much bigger will it be, and what countries will the bulk of this expanded fleet go to?
So one of the things we've had to do to solve e-commerce and to be able to become the e-commerce leader across the entire region was logistics. It was really one of the big pain points to the development of e-commerce. And so as a consequence of that, we've built out the largest and the most efficient logistics network in most of the countries where we operate. Obviously, one of the less positive impacts of that is that that has significantly increased our carbon footprint, and we are very committed to attacking that head on through vehicular transformation of most of our fleet over the long run to electric vehicles. So we raised about $400 million last year in a sustainable bond. A significant portion of that is to be able to finance the vehicular transformation. So we've committed to another 500 electric vehicles before the end of the year. That would take the fleet this year alone to over 1,000 vehicles. That's just a portion of what we need to do for the long run. Part of the commitment around the bond was to try to transform about 10,000 of those EVs over the next 3 to 5 years. So that's what we're working on. Clearly, right now, demand is outstripping supply. And so there's a lot of commercial agreements and business development that we need to continue to carry out to make sure that we can receive commitments for those 10,000 or ideally more EVs in the upcoming years.
Interesting. Last quick question. I've only got about a minute left, Pedro, but obviously you have a huge credit business, and I'm curious how you think the downturn will impact that. Do you think that means, more potential defaults or more non-performing loans?
So credit is a cyclical business. I think what we're very encouraged by is that the quality of our underwriting has been very good. And so whatever deterioration we've been seeing in the books was deterioration in line with what we had anticipated at the moment of origination. And so that's been priced in. So really the overall profitability of those credit books continues to perform within expectations, despite a bit of a macro downturn that does hit NPLs.
Pedro, thank you so much for giving us a snapshot on what's happening on another side of the world. Pedro Arndt, CFO of Mercado Libre. Thank you. Coming up, how the M&A outlook may have seemingly changed overnight after Tuesday's sell-off. That's next. This is Bloomberg. Welcome back to Bloomberg Technology. I'm Emily Chang in San Francisco, turning now to M&A. August was strong for tech deals. Nearly half of VC investments went to tech, media, telecom last month, but overall M&A activity is down significantly here in December, according to S&P Global Market Intelligence. Let's talk about this and more now with Stefan Felgois, head of global M&A at Goldman Sachs, as well as our Bloomberg Deals reporter, Ed Hammond. Ed, Stefan, thank you both for joining us. So, Stefan, you couldn't be in a better position to tell us what the deal is. Obviously, we're heading into a significant economic downturn. There's been a significant slowdown in M&A. Is there a rebound before the end of the year, or is that a long ways off?
Look, I think I'll be very balanced about the M&A market. Just to level set and give you a perspective on last year versus this year. Obviously, last year was extraordinary. Year to date last year, we saw about $4 trillion of activity overall in the M&A market. This year, it's about $3 trillion. So think about kind of 30–40% down from a dollar volume, but also from a transaction level. But many of the foundational pieces that drove the M&A market remain very much intact. You think about equity capital looking for opportunities. You think about private equity. You think about corporations looking to position themselves strategically for the long term, something that we saw very, very strongly last year coming out of COVID. So there's certainly reasons to think about drivers of strategic and corporate and private equity M&A activity. That being said, you certainly need to be balanced and need to be guarded that we're looking at a year that is pretty close to the 5-year averages, maybe a little bit above. And 2021 obviously was just an exceptional year.
But Stefan, let me pick up on that. If the drivers are still there, and yet, as you say, we're going to be down probably at least 30, 40%, I guess the obvious question that raises is like, well, then what's slowing it? Is this just interest rates? Is this just the fact that we're late cycle, or is there something else going on here?
Look, I think there's a lot of things. I think it's late cycle. I think there's global volatility and instability that we see every day. M&A is driven by CEO confidence. That is the number one driver. And there's certainly a lot of things in the market, whether it's interest rate increases, inflation, again, global instability, that have caused people just to slow down a bit. It doesn't mean that the backlog, for instance, of private equity portfolio companies that want to be sold is any different. I think it's a question of when, and when would those come to market.
But that's a shift, because the CEO confidence point I agree with, but they've been able to see through a lot of this volatility before. They were able to see through COVID, after all, and all of the sort of uncertainty that came out of that. So what is it now that's going on that's made CEOs say, okay, we're not going to pull the trigger, we're not going to do those big deals? Because that, particularly in the market, we have seen a real slowdown, the sort of the big mega cap deals, if you like, that imply that higher risk appetite.
Yeah, there's actually been a tremendous number of very large transactions this year. But if you're a CEO, again, I mentioned and talked about the CEO confidence issue, you're still looking, you're still talking, you're still discussing with your board the timeline to executing, the timeline from execution to closing. Those have extended and become more complicated. And so you're seeing a bit of a pause, as we just talked about. But again, back to those fundamental drivers, the dialogue is still there. In fact, if we look at the new mandate checks that come into Goldman Sachs, those are running at levels very consistent with the beginning of this year, and certainly at various periods running consistent with what we saw in 2021.
So we're looking at a very good end to
I'm
the
curious.
year?
We certainly could be, and I think it's more a question of when. Obviously, the interest rate raises have a quelling effect. And so I can't sit here and say that's going to be fourth quarter, that's going to be first quarter next year. But again, a lot of those drivers remain in place, and I think it's a question of when, not if. But we're certainly seeing balance and a bit of caution in CEOs and executives right now.
Stefan, I'm curious if you're seeing much buyer's remorse, because yes, we saw handshakes on some big deals at the end of last year, at the beginning of this year. Thinking about Twitter and Elon Musk, and now him trying to get out of that deal. He says it's because of bots. There's also some speculation from Twitter's side that it's because the market and the conditions have changed. What do you think?
So, Goldman Sachs advised on Twitter, certainly wouldn't comment on the Twitter situation, but in general, we have seen institutional investors and boards applauding their management teams from doing strategic transactions and looking to put in place the strategic foundations, not for the next year, but for the next 5, 10, 15, 20, 30 years. And institutional investors have very much supported that. So we have not seen, certainly have not seen widespread buyer's remorse for any of the large transactions that have been announced in the last several years. And in fact, we've seen institutional investors continuing to encourage their management teams and their boards to seek out strategic opportunities.
Stefan, talk to us a little bit about the regulatory environment. We know under this administration there is a toughened stance as it relates to sort of traditional antitrust, but particularly around big tech. And I wonder what your clients are saying to you about that, what it's done to their appetite, and indeed what advice you can give them in terms of pulling the trigger on some of these bigger, more complex deals.
Sure. Look, regulatory has been a factor in every administration for many, many decades. It's one of many factors that we spend a lot of time with our clients and with boards on. But again, it's one of many factors. And there certainly has been very substantial large tech activity, as you have seen. And so it's not stopping management teams, it's not stopping tech boards from thinking about what is the right strategic positioning. Is it relevant and certainly very important, and we spend a lot of time talking about it? Sure, absolutely. But that's not different than past years or past administrations in terms of how you think about regulatory being one of many factors that you consider in a transaction.
One of the opportunities that seems fairly obvious for buyers at the moment is the foreign exchange arbitrage, if you like. If I'm a US corporate sitting here looking at my opportunities, how attractive is Europe and the UK right now?
Well, certainly currency has moved dramatically, as we have all seen. What I would say is, cross-border has been one of the areas that's been less active. So certainly currency could help that, but it's, again, one of many issues. And so, COVID was certainly a big quell on people meeting face to face, which is an important part of doing deals around the world. And you really haven't seen a big pickup or resurgence in cross-border. And I wouldn't say that currency has really caused that to change dramatically. But certainly it's been certainly for global companies, it has a huge impact on their earnings, and they all focus on it, but I haven't seen it being a big factor in cross-border M&A.
Stefan, I wonder if you think that could change, especially going into next year if the dollar remains strong, and where you do see in what sectors, whether it's cybersecurity or social media or artificial intelligence, where you think that M&A could pick it up if and when it does.
Look, I think technology is pervasive. It's not just tech-to-tech mergers. It's industrial technology. It's consumer technology. Technology is pervasive in healthcare. And so when you think about transaction activity and technology specifically picking up or becoming more active, it's going to affect every industry. When you think about the most active industries now, certainly healthcare, certainly technology, certainly industrials, but it's mainly, and big parts of it, are the technology components of those industries. So I certainly expect that to remain strong, but I think you got to look much broader than just core technology when you think about technology's impact on the M&A market.
All right, Goldman Sachs head of global M&A, Stefan Felgois, thanks for giving us a global view today, and our Bloomberg Deals reporter, Ed Hammond. Appreciate it.
Thank you.
Okay, coming up, it's a countdown to the Ethereum merge. We're going to be joined by Dragonfly Capital partner Tom Schmidt to talk about just how high the stakes are. This is Bloomberg.
The Ethereum merge is a really big story. It's finally here, and that gives energy to the space.
Going proof of stake is a huge step for Ethereum. I think it just makes the network much more secure. It is using less energy and ready to be much more scalable.
There will not be any more mining. Ethereum's energy consumption will go down, so it'll go from being a big problem to basically not a problem at all.
You now have a productive asset. So whereby in the past, yes, you could hold your Ethereum, yes, you could use it, but if you're an institution, now you can stake it and you can earn a yield on it. And that is, I think, definitely going to be a turning point for Ethereum.
We've been, much more excited about Ethereum in the last month or two than Bitcoin.
I'm personally really in love with Ethereum.
I don't necessarily think move to proof of stake is a great thing for Ethereum in the short run.
What I care about is that the merge is successful and that this upgrade does not have a technical glitch.
It'll be as smooth as if your iPhone or your laptop has upgraded its operating system automatically overnight.
Ethereum has been promising proof of stake since basically they started. Wake me up when the transition happens.
Thoughts there from many guests across Bloomberg Television about the upcoming merge. For more, I want to bring in Tom Schmidt, a partner at the crypto-focused investment firm Dragonfly Capital, and of course, our very own crypto contributors, Sonali Basak. Tom, so we think it's going to happen in the next 24 hours. Look, are you expecting a Y2K situation here where we all think it's going to be a big deal, but nothing really changes? Or will this have a dramatic impact on the current landscape?
I mean, I think it's not going to be Y2K-like in the sense that this has been pretty battle-tested at this point. All of the different Ethereum testnets have gone through this upgrade. And really what we're waiting for is Ethereum mainnet, sort of the big show to finally go through this upgrade as well. And we're expecting it to happen in about 7 hours. So someone might want to call Nicholas Weaver and wake him up then. But everyone's pretty excited. I'm in Berlin right now for Blockchain Week, and it's sort of the talk of the town. I think there's pretty much general consensus that, hey, this is not only a massive upgrade for Ethereum as a network, this shift from proof of work to proof of stake, but also an incredible upgrade for Ether as an asset. There's going to be a 90% reduction in Ether emissions, so making it much less rare, but also turning it into a productive asset, as has been said before. Now, people who hold ETH can stake it to secure the network, earn a yield, earn fees, and ETH itself is being burnt as these transactions are going through, making it potentially deflationary as well. So overall, it's just a great bundle of upgrades that make Ethereum as a network, safer, more sustainable, make it a better asset, and really pave the roadmap for the rest of Ethereum scalability.
So Tom, I want to dive into the staking question just for a second here, because I think it's a little bit misunderstood and undercovered. Do you think staking as a business becomes a risk at some point, given some of the regulatory concerns about it? And would that impact what this new model really looks like and the ability for people to stake?
Yeah, this has come up more, especially I think in light of the Tornado Cash OFAC sanctions that were announced a little over a month ago. So far, I think we've seen the guidance to be that if you run a validator, if you're a miner or a validator on a network, you're not responsible for censoring the types of transactions and monitoring the types of transactions that you're processing. You're sort of a neutral entity. You're like an ISP in a way, where different ISPs are not responsible to inspect and monitor all the packets that they process. That might change in the future. I suspect it won't, but certainly it is something that we're monitoring and looking at what's coming down the regulatory pipe. But overall, I think one nice thing about this upgrade as well is it does just make this process of securing the network and validation more accessible to average people. Most people are not going to be Ethereum miners or Bitcoin miners. They're not going to spin up massive rigs in some rural area in order to secure the network. But now the people who actually own Ether can stake it and earn a little bit of yield, as well as make the network more secure.
What do you think about it relative to Bitcoin? On one hand, I want to ask you, just in terms of a valuation and usage standpoint, but also culturally. You see a lot of people splitting off, defending one chain or the other, and I'm wondering, what do you think it really does to the community, and does Ethereum become more dominant?
Certainly, proof of stake is not all roses. I think there is concern that there's this sort of rich get richer type effect, where if you own Ether, you can get more Ether, and really the only way to earn more Ether is to buy some Ether. I think at the same time, there is concern that hey, maybe there's going to be a vulnerability, maybe there's going to be some sort of bug. I don't really like the fact that the economics of Ether are changing over time. What if they change in a way that's less favorable to me? And so I think some investors will still prefer Bitcoin and sort of its inertness, and the fact that it doesn't change. It does what it says on the tin, and it's probably never going to change and go through a massive upgrade like Ether. But I think ultimately what we've seen is, this is a technology as well as a type of, monetary asset. And in the long run, technology that is able to iterate and upgrade will win out over technology that can't. And so I think when I talk to entrepreneurs, as an investor, most of them are excited about building on Ethereum or other smart contract platforms. And you don't meet as many who are excited about building on Bitcoin.
We've talked a lot about how this might impact Ethereum, but I wonder what you think the repercussions will be for other blockchains.
Well, a lot of other blockchains, smart contract platforms in particular, already run on some form of proof of stake. So in many ways, Ethereum is sort of catching up to where other smart contract platforms like an Avalanche or like a Solana already exist. As it's been mentioned, this is something Ethereum has had planned for many, many years, basically since its inception, and they've been developing it and researching it since 2018. So very exciting to finally see it live. I think if anything, there is sort of increasing pressure on proof of work blockchains and in sort of inspecting their energy usage. There was a report out, I believe this week. There's a series of reports that the White House requested around cryptocurrencies, and the one specifically this week was around energy usage and looking at ways to potentially cap or regulate the amount of energy that Bitcoin miners use within the United States. I think it's not as cut and dry as people make it out to be. Oftentimes that energy is greener than it would than your average energy mix. But at the same time, now that one of the largest cryptocurrencies, blockchains, is moving to proof of stake, there might be more scrutiny around this particular aspect.
Emily had such an interesting question about the Y2K moment. There's technological questions about this, but also one around capital flows. Do you think that there really is a critical scale of people who are looking to kind of buy into the merge? Or do you think that there are a lot of people on the sidelines that are simply waiting for all the upgrades that are still ahead?
Yeah, I think some people might be willing to, sit this out and, wait to see if there's a bug. One of the other popular trades that people have been discussing and engaging in right now is actually buying ETH and waiting for the ETH proof of work fork, which is a community-driven fork, which will undo some of the changes that Ethereum is making right now and revert it back to its current form of proof of work after the proof of stake upgrade goes live. And that proof of work fork will be airdropped to people who currently hold Ether. So in a sense, you're sort of double dipping. You're getting not only the ETH proof of stake fork, but you're also getting the this ETH proof of work fork. I don't suspect it to be particularly successful. I don't think there's a lot of excitement around engineers around it, but you never know. And that's sort of the cool component of having a permissionless financial system is anyone can try an experiment and we can see if it works. And we'll sort of see what how the markets react to these different approaches.
All right, Tom Schmidt, Dragonfly Capital Partner. We will see what happens over the next 24 hours. Bloomberg, Sonali Basak. I don't know if you're going to get any sleep tonight, Sonali, waiting for this.
I am excited to see how it all goes.
Hopefully you do. Thank you both for joining us. Coming up, we're talking about Nikola and the trial of Trevor Milton with key witness testimony next. This is Bloomberg. A key witness in the criminal trial of Nikola founder Trevor Milton told a jury he made $600,000 from a short seller's report about the company. Paul Lackey taking the stand in Lower Manhattan court for a second day on Wednesday, facing charges he lied to investors about Nikola's technology and progress to pump the stock. Joining us now, Ed Ludlow, who's been in court every day following the proceedings. So Ed, tell us a little bit about Paul Lackey, who he is, and why he matters.
Yeah, so Paul Lackey's an engineer that worked at a company called EV Drive. And in 2016, Trevor Milton contracted with EV Drive to work on the first prototype of Nikola's debut truck. And as we reported in June 2020, when that truck was unveiled in December of 2016, it was missing key components. It never functioned. And on day one of testimony on Tuesday, Lackey explained it was missing key parts to government prosecutors. Day two, Wednesday, it was the defense's turn to cross-examine. And in so doing, it emerged that Lackey had basically sold information, the information that key parts were missing and that it never functioned, to Nate Anderson and Hindenburg Research, the short seller that published the short report in September 2016 that ultimately set in motion the series of events with Trevor Milton resigning that year and being indicted last year, and now the trial is underway here.
Let's get back to the basics, Ed. What are both sides trying to argue here?
Yeah. So Trevor Milton's charged with 2 counts of securities fraud, 2 counts of wire fraud. But basically, government prosecutors need to convince the jury, firstly, that he lied or he made misrepresentations about the company's technology, its business progress, its commercial agreements, what it had actually achieved. But more than that, they have to prove to the jury that those misrepresentations actually caused retail investors to buy the stock, or that what he was saying was done in an effort to pump up the stock. Now, the defense are going to argue that he genuinely believed what he was saying, that he was telling the truth of what Nikola was trying to achieve. There's going to be debates from the defense about issues of linguistics. What does a prototype mean? What does it mean to build something? But the focus is him genuinely believing in what he was doing and what he was saying. And that argument might sound familiar to you, Em. I'm thinking, of course, of Elizabeth Holmes and the trial you and I covered in San Jose. The big difference, this is a publicly traded company, though it went public via a SPAC.
Well, and on that note, I believe you're referring to the trial of Elizabeth Holmes. It was a very lengthy trial, several months, then a very lengthy deliberation process. Is that what you're expecting here?
So we're expecting 5 weeks. The judge briefed the jury, Edgar Ramos, briefed the jury that they can expect to be sitting until October 14th. And, there's just a wide range of documentary and witness evidence to go through, right? Trevor Milton was an avid tweeter. Many of the statements that he made that are being reviewed were tweets. There are promotional videos, there are interviews, podcasts, but 5 weeks it will last. The first 3 weeks likely will be the prosecution kind of making their arguments and calling on their witnesses before the defense finishes things up towards October.
All right, Ed Ludlow, we'll continue to get your updates from the courtroom. Thank you so much for that. And that does it for this edition of Bloomberg Technology. Thursday, we're going to be talking all things merge with the president of FTX US, Brett Harrison. And don't forget to check out our podcast wherever you get your podcast for the Daily Tech News Roundup. I'm Emily Chang in San Francisco. This is Bloomberg.